Monster is a very popular beverage company with basically no debt and very high margins. In today's video, we're going to look at the numbers and evaluate whether or not buying the stock at today's price could make sense. So the numbers are that they made a revenue of $7.5 billion in the last year, with a net income of that with $1.5 billion, which gives them a very respectable profit margin for 20% for a beverage company. They're currently selling for $81 a share, which gives them a staggering PE of 52 based on last year's numbers. So that is very expensive currently. The market is apparently expecting a lot from this company. Now let's look at two different cases, a bear and a bull case, to evaluate whether or not buying it at this price and PE could make sense. We're going to look at a simple 5-year analysis. And for a bear case, I would expect a more slow revenue growth of 7%. That is a bit lower than their average revenue growth over the last decade or so. But it is still respectable, especially for a bear case. It's not declining, and that is the important part I want to highlight here. But I would assume that their profit margin maybe shrinks a little bit in a bear case, that other beverage companies can climb up the ladder in popularity, maybe force their pricing power a bit down and so on. But they are actively buying back shares, and a lot actually. So I would expect a roughly 6% share reduction. And evaluating the company is a bit difficult, especially considering that it's currently selling for a very staggering around 50 PE. So giving it something that is significantly lower than the current PE can feel a bit weird and almost unrealistic. But for a company that is growing older and more mature, and you can see that their numbers slow down a bit, I think paying a PE of, let's give them the benefit of the doubt and go with 20. That is still very good, very above average, but not what they're currently selling for. This would take the stock price to a price of $55 per share. And if bought at today's price, that would mean a reduction of negative 7.24% year over year. But in contrast to that, let's look at a bull case, of course. And this time a more higher revenue growth of 11%, assuming that they can still carry on with their lower double-digit growth over the next 5 years. And staying the same, very great 22% profit margin and a bit less share buyback because the stock would stay a bit more expensive. And I increased the PE in the other case, so let's go with a PE of around 25 for such a company that is still able to pull off double-digit growth. And this would take the stock price to around $96, and by today's price, that would mean an annualized return of 3.61%. And if we combine these two cases together, the average would stay basically flat to around $76 with an annualized return of 1.22%. So currently, I am either missing something in the company that a lot of other people are seeing, but for me, the stock is currently way too overpriced and it's way out of my reach, or what I would even remotely call a margin of safety. So I'm gonna keep the stock at my watch list at a much, much lower price. And maybe one day it will get there, or maybe not, but I'm happy to never include the stock in my portfolio if it never goes down there. But in case I'm missing something very important, please let me know down in the comments. And thank you for watching. I will see you in the next one. Bye.